Today I'm presenting a fintech buy and build opportunity built around payroll, payroll payments, and financial services. The opportunity lies in joining these industries that already serve the same employers and employees, but currently operate separately into a single enterprise. There are three connected business sectors: payroll support services, financial services, and payroll payment providers. Each already has access to employers and employees. The opportunity is to bring these relationships together into one integrated financial services group. The first leg is payroll support services. This includes Sage Business Partners, PaySpace Business Partners, Payroll Bureau, and Payroll Authors. These businesses sit close to employer payroll data and have trusted client relationships. The second leg is independently owned brokerages. Many are non-listed, owner-managed businesses. They already advise employers and employees, but often lack direct real-time payroll data. These two legs of the service parties work from the same data, but there is little or no live integration. The payroll support service providers are responsible for ensuring that the financial service deductions from payroll are accurate and reflect the terms of the employee's contract with the service provider. The financial service provider needs to ensure that the information they are receiving and updating their internal systems with is an accurate reflection of the payroll. The provisions of the payroll data to the relevant service provider is often a manual process with little or no electronic transfer of this critical data. Payment providers sit at the point where payroll becomes money movement. They process large volumes of financial data, offer cost savings compared with traditional banking, and add value through reconciliation and payment control. The payment service providers also sends huge volumes of appropriate data when making payment to the affected third parties. The payroll payment provider becomes the bridge. It links payroll support services and brokerages through shared data, creating revenue sharing opportunity while improving service to employers and employees. Years ago, Sage made the decision that they wanted to be a product service provider only and provide support to their extensive client base via business partners. They offered all the support personnel the opportunity to start their own businesses, supporting their existing clients for their own benefit. Never having been responsible for the running of a business before, many of the consultants approached money men to assist with their startup business. As a result, while the payroll support businesses are independent, many are not managed by the major shareholders. Their investors and owners want better returns on their investments and a clear exit route. At present, the main option is often only a management buyout, which may be limited by cash flow. The same challenge exists in many, if not most, of the independent brokerages. The majority owners are approaching retirement and need a practical exit strategy. A listed group can offer cash, shares, continuity, and future growth participation. Profile Corporate Services already has the technology base. Besides the superb payroll payments technology, it has developed associated products for the industry, which include ePayslip, eClocker, eRoster, eTicket, and eCommunications, with integrations into common payroll systems. This makes Profile the natural platform for the group. Profile sits at the center of the model. It can connect business partners, brokerages, employers, and employees while enabling shared revenue and better data exchange across the group. Using this model, the business partners will introduce the financial service providers into their client base and enjoy at least 10% of future commissions earned on group benefit policies that they introduce to the financial service provider. Currently, the business partner is responsible for the accuracy of the payroll data, but does not enjoy any revenue earned by the financial service provider for the provision of that data. As a result, the business partner is not involved with the financial service provider regarding the relevance of the data they receive. The business partners would share 40% of the profile corporate services revenue on the monthly revenue generated by the use of their fintech products. Business partners can earn as little as 18 to 20% of their annual revenue as annuity income and have to look for 80% of the annual turnover as new business. Because of the shared revenue model, the business partner will promote the group products and services for the annuity revenue it generates. To integrate these businesses, capital is required to acquire the right entities. A large private capital injection is one route, but it limits flexibility. A JSE listing creates a better mechanism for acquisition using both cash and equity. The projected capital required for the acquisition of the business partners and the financial service providers would place a prohibitive debt structure on the proposed group. The money from the IPO generated by the AltX listing would make cash available immediately for acquisitions without the burden of debt. A listing provides access to capital and gives the proposed group immense credibility when approaching the business partners and financial service providers for acquisition of their companies. Sellers can choose a balance between cash and shares depending on how soon they want to exit and how much upside they want to retain. The beauty of a listing is that the business purchases are done using the seller's own money. The equity is held by the group structure and the group is exchanging that equity for the equity in the business. It is envisaged that the proposed AltX structure allows for an initial issue of 200 million issued shares with an additional 800 million unissued shares available for acquisitions. It also includes an employee incentive trust to retain key people and align them with group growth. A SPAC listing gives comfort to prospective investors that the money that they are investing in the proposed listing will only be used for the acquisition of viable companies that will add value to the group. The interest on the SPAC monies will provide the initial working capital required during the initial phases of the group, allowing it to attract the personnel required to successfully implement the vision of the group. Payroll partners and brokerages benefit immediately. They realize value for their businesses, gain annuity income, share in group revenue, increase client retention, and become a part of a larger, more credible listed entity. The executives of group companies will be expected to meet quarterly at group organized weekends to interact with each other group company to create opportunities for cross-selling of products and services. The group companies will be made to understand the value of using group resources rather than external resources as the group turnover increases and so does their share price. Acquisitions must retain the people who know the clients and operations. Retention agreements, employee share schemes, and profit sharing will help protect value after acquisition. Often, the major shareholders of the payroll business partners are not managerially involved in the day-to-day operations of the businesses, and thus the existing management must be incentivized with equity to stay with the group. And again, it is not the initial investors' money that is required to retain them. It is the future shareholders in the group. The group would operate through 4 divisions: payroll support services, financial services, payments and transaction processing, and intermediary software solutions. Together, these divisions create a single service platform. The required CEOs of the divisions will only be retained when the group has sufficient size within each group to require a dedicated CEO. Once the group reaches the required scale, it will move towards a full JSE listing. Growth will continue through national expansion, further acquisitions of associated FinServ-related companies, for example, asset management companies, intermediaries for short-term insurance, software licensing, and replication of the model into African markets. The early growth case starts from a payroll payments base and adds at least one payroll service provider and one financial service provider, which must be acquired in the first year of listing. This will see the group's turnover be at least 74 million rand by the end of 2027. This assumes the listings to be completed by October 2026. Additional acquisitions will be available when the business model is successful. The aim is to lift turnover materially by combining acquisition growth with new revenue from existing relationships. The next phase adds fintech-related businesses, wealth businesses, and further cross-selling. The acquisitions to achieve this turnover would be 6 of the biggest business partners, 9 financial service providers, and 2 large payroll bureaux by 2033. This is where the model becomes significantly larger, with new revenue streams compounding across the group. It is envisaged that the growth after 5 years will be significantly improved when the success of the model is proven. The growth forecast shows revenue rising from 74 million rand to around 1.8 billion rand by the year 2033, driven by payments, fintech products, payroll support acquisitions, financial service provider acquisitions, and additional financial services revenue. On the displayed graph, the payroll payments business is expected to grow marginally due to the low cost but significant part it plays in the group dynamic. The expected growth to be in the region of 85 million rand by 2033, the fintech products being an intrinsic part of that growth. The payroll support services from the cross-selling opportunities available and acquisitions are expected to deliver 600 million rand to the group turnover. The bulk of the growth being from the acquired financial service providers and the cross-sell new business contributing over 1 billion rand to the group turnover. There are identified Sage business partners, with the top 4 showing significant turnover in the region of 170 million rand annually. The top 13 Sage business partner turnover is in the region of 450 million rand annually based upon 2025 figures. A reasonable sized financial service provider would contribute 120 to 180 million in annual turnover, and the group would acquire these independent brokerages that fit the acquisition profile. These businesses have existing revenue, client bases, and owners who would welcome an exit or growth partner. Profile has the technology, payroll independence, market access, and long-standing experience needed to lead this model. Its strength is the ability to connect data and business between parties that currently operate separately. The anticipated revenue of just the top 20 Sage payroll service providers in South Africa show an annual turnover of 440 million rand. Identified payroll bureau turnover is 250 million, and the pay-based business partners are an estimated 250 million rand in annual turnover. Google estimates that the national turnover of the payroll industry in South Africa is in the region of 8.5 to 9 billion rand. Again, Google estimates that the financial service provider brokerages earned 5.46 billion rand in 2025, with 2.9 billion being just the medical aid commissions. Profile would contribute 85 million, with the fintech products being a significant contributor. The model draws revenue from payroll service providers, financial service provider commissions, payment services, interest income, technology development, debit orders, and fintech products. The 8-year target represents only a small portion of the available market, less than 10%. The capital raising proposal is based on issuing shares at 1 rand with at least 100 million rand required. The ideal listing would be for 150 million rand in shares, but could be as low as 50 million rand. Funds would be used for acquisitions, with sellers offered a structured cash and share purchase model over 3 years. The opportunity is built on existing foundations. The industries already exist, the clients already exist, and the data already exists. What is missing is integration, capital, and a single strategic direction. This model will disrupt payroll and financial services in South Africa by creating a listed, credible, technology-led group. With the right capital partners, Profile can become the connector between employers, employees, payroll, payments, and service providers.